Good morning, everyone. Welcome to another forms class. Today we have got the seller's financing addendum. Who knows what this addendum used to be called? Let's see. Jim's been around long enough. He would remember. Do you remember what it used to be called? I don't know. It used to be called something different. I need Zoom people.
Real estate contract?
That's an option on it. It is, let me share my screen.
Then you say it well now.
Okay, let me hide this.
Been a while since we've been there.
All right, here we go. Let's get to our form. So seller financing addendum purchase sale agreement used to be called sellers. I'm trying to remember too. I had it this morning. I was like, oh, that's so funny. It used to be called this. Sellers. Nope. It was.
Seller in it, but
Oh my goodness. It's going to come to me. All right, I'll think about it. Let's start things off. This is a multi-use form. And Annie Fitzsimmons says it was one of the most complicated forms in the whole library. So it's definitely, this is one that if you are in this situation, that you're gonna definitely have to take some time. Every single time I even help someone out on a deal to where there's seller financing involved at all, I always have to bring out the manual again and kind of like reread it again and go, okay, let's look at this again to remember which options are which, because it is quite complicated. All right, so first things first, limited use. There are various federal and state restrictions that limit a seller's eligibility to finance the sale of real property. So these limitations apply when the property will be used for a residential dwelling. Accordingly, Form 22C requires, it's called payment terms. That's what it used to be called. It just came to me. So they finally changed around to like, yeah, seller financing is truly what it is. So if the property will be used for a residential dwelling, right? If the buyer represents it will use the property for a residential dwelling, then the seller and the financing must comply with the following requirements. So first one is A, seller must be a natural person, estate, or trust, and not a loan originator. So they don't want people like cutting off all of the other mortgage companies and banks and actually not following guidelines and rules. I mean, that's basically to sum up the reason why they don't allow that. That is, I'm sure, money too.
Well, yeah.
Right? The fees.
They made it harder and it's been around for a long time.
Oh yeah, long time. The seller must not have financed the sale of another property within the past 12 months. That's another requirement.
Did any ever talk about like why some of these requirements work? I don't understand. It just must not have financed the sale.
They don't want that because otherwise they're kind of acting like a what?
Dealer.
Like a bank, like a dealer. Yeah, like, hey, I'm just gonna go around and do a bunch of these and I can make more money. Like, no, they don't want people doing that.
With residential, they mean, do they have to live there or can be?
Yeah, it's well,
Is it investment?
investment I think is fine because it's primary, it's more or less a residential, personal residential dwelling. I don't know, Jason, you came from the finance world. Did you remember any of that?
Well, I know why they don't allow it is because you don't want to act as a bank because of the regulations.
Mhm.
And you don't want anyone to be scamming people out of equity.
Oh.
Be stripping.
Yeah,
Because what you could do is you could get something under contract and then do seller financing and do a wrap or something on it. And then you can you can skim the equity out of it.
Oh, yeah, I mean, but
that's definitely a bigger reason.
Fraud.
Mm-hmm.
yeah, because I knew some people did that.
Yeah,
It's the seller subordinate his interest.
yeah, that's exactly what they were doing. All right, so the seller must not have constructed or acted as a contractor for the construction of a residence on the property in the ordinary course of the seller's business. The repayment schedule must not result in a negative amortization. And the financing must have a fixed rate of interest or an adjustable rate of interest that is adjustable after 5 or more years, subject to reasonable annual and lifetime limitations on interest rate increases. So they at least have some guidelines and rules on what you can do for, when a seller's offering their financing. They can't do some crazy, like, oh, I want to giving them people an adjustable rate, like, oh yeah, it just adjusted again. Like we'll agree that it'll be 10% above whatever the current rate is. But if it goes down, ours doesn't, like making their own rules up. It's just that kind of stuff is just not allowed. Okay, so if the property will not be used for residential dwelling, then the above restrictions do not apply. So there you go. There's the residential dwelling, like, so it's not gonna apply if you got a bunch of tenants. Washington State DFI waiver or exemption. If the property is currently used for a residential dwelling, the seller must either, one, obtain a waiver from the Washington State Department of Financial Institutions, the DFI, under the RCW 31-425-3, or to identify an exemption from the RCW 31-4 under the WAC 208-620-104 or the WAC 208-620-105. No waiver is required for vacant land. If the seller does not timely obtain a DFI waiver and give notice to the buyer of the same, the buyer has the right to terminate the agreement. If the seller is not exempt and has made a good faith effort to obtain a DFI waiver, but DFI does not grant the waiver, the seller has the right to terminate the agreement. So there's some, strict things in here that has to happen, and that's the DFI waiver.
Have you seen one?
Yeah, you can pull. Well, here's the thing for let me open the link, hopefully Zoom people. Oh, nice, the link is broke. Well, that's not good. I wonder if they even know that. Oh, there's a question, yeah. I'll have to let the MLS know that is a dead link.
Used so often, right?
Yeah.
Well, I think it's gonna be used more. I've seen more.
Yeah.
Self-financing.
Yeah,
I saw a statistic where there's so many free and clear properties now, the most that there's ever been.
right. I mean, one of those things, like, they come back. Every hard, tough market. And what else? What's the other reason why we might start seeing these?
Well, with the interest rate still kind of up there.
There it is.
You can do like someone.
Well, it depends on the loan though. I mean, on a conventional loan, they had an attorney in Belgium, I can't remember his name, who was wrapping conventional loans as real estate contracts, so it wasn't recorded in the seller's name. And there's a whole course on that back in the 80s.
Yeah.
And I can't remember the attorney down Eldon Long or something like that down in Auburn was legendary for
Doing a bunch of those wrap loans.
Yeah, cat.
Ugh.
Because they took it away. I mean, basically,
Mhm.
the 70s, you had a lot of wrap loans. And, and then you could say, oh yeah, you're gonna get a 8% return on your money. Your rate's 4%, we're gonna do it at 6-7%.
Yeah. All right. So C is disclosure. If the property will be used for a residential dwelling, the seller must provide the buyer with a disclosure summary of the material terms of the loan and the cost of financing in accordance with requirements of the DFI or a compliance federal disclosure under the Regulation Z. LPB forms. So LPB forms referenced in Form 22C are available through a link on Express Forms and at there. So it says it's available on Express Forms. So let's go see if they put it in at the top or bottom. There's a section. Let's see. Right here. Oh, it's at the bottom. So here is the section for mortgage lending documents. The section 1 talks about an assignment of reserve account funds, Department of Housing Urban Development documents. And then in section 2, there are a lot of documents in here
For the DFI.
for everything that's governed under DFI, but it's all of, there's things for a bargain and sale deed, Word document version, or a PDF, quick claims.
Is that through the multiple that you get?
That was right from right here.
Loan practice.
So this is the, yeah, escrow documentation. You've got the cover sheet, statutory warranty deed. These are all like the blank documents needed to do all that. But let's see, where is the, oh, there's real estate contract, long form, short form. For the, no, what is it called again? The forms.
Next is all the riders that we want on top of your mortgage.
Yeah, so we need the DFI waiver, right? Or let me just put in waiver.
One here.
Waiver. Yeah, there's only 4. Doesn't go straight to the. Yeah, I'm gonna have to follow up with them and ask.
Who did we talk to? Maybe I'll call.
Well, no, we'll call Northwest MLS because it's supposed to be the correct link to the waiver.
I'd like to know what you have to do.
Yeah.
How long it's gonna take.
Yeah, see, you have to be sure to attach a blank copy of the applicable LPB forms to Form 22C. So you're supposed to attach it.
I think if you would do this, you'd want to talk to your title and escrow rep.
Oh, yeah, they definitely can get
And
it.
also your attorney.
Yeah.
So you can talk about the draft of your mortgage, trusts.
Yeah.
They're all proper, so
Yeah.
there's a little bit of legwork you can do in advance before.
Yeah. Every single time you guys are involved in one of these types of situations where, the seller's gonna do, the seller financing, it's always a good idea to remind them that, they can seek legal advice. And especially if they're trying to do the amortization and all of the other payment schedules, and that's stuff you guys cannot do. I had someone come to me one day, they had a Word doc on their computer, like, hey, I think I did this right. I'm making an amortization. I'm like, no. I'm like, oh, I remember I said, oh, dang, I didn't know you passed the bar exam. And then they were there, I go, oh, I'm not supposed to do this? I go, no way. Think about it. What if your calculation's off? Or, and you're making the documents to be recorded? No way. Oh, okay. Yeah, so.
Hey, Eric, would you mind checking your text real quick?
Yeah. Let's see. Okay. So you got. Yeah, you got a bunch. Holy moly.
This is just from trying to look stuff up real fast, but I could totally be wrong.
Yeah, well, Form 23 is, go back up here.
That was revised in August of 2024, so it's pretty recent.
Yeah. Huh? No, that's just, Form 23 is a manufactured home purchase and sale. But, yeah, that's different. Don't worry, guys. I will reach out to Northwest MLS and I'll hit up Jeannie Simpson, the lead attorney there. I know really well. She used to be John L. Scott's legal counsel, so I got her bat phone. I'll just call her. But we'll get that. So attorney review. We were just talking about that. Let's see. Jim, you want to read E?
Sure, attorney review. Please note that transactions involving seller financing are complicated, often require special expertise. You are advised to seek the advice of counsel, and you should advise your client to seek the advice of counsel. The boilerplate of the addendum contains a contingency for attorney review for both the buyer and the seller.
Yeah, so it's such an important, document that they, all the forms committee and the attorneys from the Northwest MLS, they actually put together and got together and said, hey, you gotta have an attorney review contingency in this, just automatically.
Right.
Because you guys know, we talk about that form all the time, the 22 RA. Attorney review contingency, you can put that in any transaction. Anytime you're like your gut, tingles, or you get the spidey sense, right? And you're like, I'm not liking this. You definitely can use that addendum on anything. We definitely, pretty much require it on any transaction to where it's an off-market sale and there's an unrepresented party. If there's any unrepresented party in there at all, you have to add that in there. That's really the only shield of protection you will ever have. And you got to do it from the beginning. And so you got to have that 22 RA in that deal. And that is, if someone was going to sue you and they go see an attorney, the attorney's going to review all the documentation. They're going to sit down with that client and they're going to say, oh, wait a minute, you had an attorney review contingency. You didn't have me review this. So which attorney did you take it to? And they're going to go, oh, we didn't take it to anyone. Well, why didn't you? That was your, wow, well, this is going to be a lot harder now, unless you did something just straight up fraud, then of course that's probably not even going to matter. But at least having that in there is probably the only shield of protection you're gonna get. All right, mandatory attorney review. So important. Now they also talk about the addendum provides that if the parties make any changes to the addendum or an attached limited practice board LPB form, then the parties must have the purchase and sale agreement reviewed by legal counsel. The purchase and sale agreement will terminate unless both parties give notice of approval by their counsel within the time period provided. All right, assistance in filling in the blanks. So we'll start getting deep into the form now. So obviously, we'll click on this. So 1, of course, is the date. 2 is buyer's names. 3, seller's name. 4 is the property address. Okay. So first things first is the limited use. Buyer represents the property will or will not be used for a residential dwelling. If the property will be used for a residential dwelling, this addendum may only be used if seller's natural person. This is all the same stuff we went through on the earlier section. And then, of course, Washington State DFI waiver or exemption. If the property is used for a residential dwelling, seller shall either 1, obtain the waiver. Same thing. That's exactly what we read above. And then disclosure, same. Limited practice boards, forms, same thing. Attorney review. So here's the section on what we read. So default 5 days, that's fine. That's perfect. You guys know the weekends and holidays do not count for computation of time. And then this is the other section that if they do agree to the financing terms that differ from the terms in this addendum or attach the LPB form, then you must have the 10 days. And I would stick to that. I would stick to the defaults for these ones. All right, let's go back and look at number 5 section is insert the total down payment, which includes the earnest money and any additional money down. So section 5. Is right here. So we're really on to page 2 now. So this is the payments to seller and the method of payment. So here's the down payment. Buyer shall pay a down payment, including earnest money, which shall be applied to the purchase price at closing as follows. So here's the earnest money amount, the additional money down, and that will equal your total down payment. So you're buying a $500,000 home, and buyer's going to put 100,000 down and 25,000 in earnest money. You'll have 25,000 earnest money, 100,000 for down, 125 will be on line 45. Next is the interest rate. Balance of the purchase price, the indebtedness shall accrue interest at a % per annum. Interest will begin to occur on either A, closing, or next checkbox, a date. Closing if not neither one's checked. You're probably going to mark closing, and there's certain situations where it might be different. And how do you guys choose it? How do they choose an interest rate? Let's say you're the listing broker, you're representing the seller. How are you going to decide what's a good rate? Where would you start?
Look at what prevailing rates are right now, and if you wanted to have it, if it's an adjustable, have it tied to some index that is usually used for a mortgage.
Yeah, definitely. Start with, what is the current rates? What does the seller have? Does the seller does the seller own the property outright to begin with?
Another thing to keep in mind is there's companies out there that actually purchase these notes on the secondary market. So if you structure this in a way that could be sellable,
Yeah.
that's a bonus for your sellers because.
Well, it gets amount of cash, but the problem with the like asking what the seller asks, it'll depend on it. Does he have to sell this way because the condition of the property, which I've seen, and we had rolling floors, and they say, okay, we're gonna sell them a contract.
Oh, yeah.
Or basically, are they selling, or is they basically saying, okay, I want a higher rate, because, I can get more money. How do I, it's cash now versus something later, and how much down are we asking? It's under 20%.
Another thing you want to do is look at the borrower's credit worthiness.
Right, well, that's
Do
in
they
there.
have? If they have the debt to income to support the.
Yeah.
mortgage.
Well, again, why do people do this?
Why do what people buy?
Why do people want to do owner contracts like this? Why, as a
Well, they-
buyer?
Well, sometimes they have bad credit.
Yeah.
There might be a spouse or somebody, they need two people to buy, and so they'll say, here's a situation. They want to buy now, or sometimes they're, and it also depends on, again, if you buy in a real estate contract, then you kind of keep your eyes, because the note deed of trust is recorded in the buyer's name, real estate contract.
Mhm.
He says, I know it still stays in the seller's name. So you have, so it's like you can hide money, so to speak, that way. So.
Yeah, there's a lot of reasons people will do it, but most of the time, it usually is some kind of a situation where maybe their credit worthiness is not good enough, but they can afford it, right?
Where a seller has like a low mortgage, but maybe like a 2% mortgage on it, and then they can kind of roll that in.
Assumable. Now you're talking assumable, which we're not even in that section yet. That's another option
But have you seen?
in the payment terms.
Currently, have you seen any conventional loans that are simple?
No,
FHA.
it has to be government-backed loans are the only ones that can be
Yeah.
assumable. So you're looking at FHA or VA, that is it.
Right.
Do you guys know how long those take to do?
Do what, to do an FHA, or to do a
Assumable.
assumable loan? Well, I think, they used to not take that long at all. And now you have to.
That's fast.
How long would you
At
think?
least 3 months.
That's fast. We have one that we're still waiting on and
It's 60+ days, and the banks don't even want to do them.
that's fast. Dude, if you can get 60? I mean, I haven't even heard anyone getting done that quick.
Because of why? Because FHA and VA want to approve the loan? or-
No, it really comes down to the mortgage companies don't want to do it. They already have the loan. They just want to receive payments. They don't want to have to go through the whole process and be a bank.
Right, you're talking about.
Because you gotta qualify the client. They gotta go through the full mortgage process with the same lien holder, the same exact mortgage company that the seller has.
Even if it's FHE or VA loan, I mean.
Doesn't matter.
Servicers and everything.
Same servicer, same, yeah.
Well, yeah,
Yeah, we have one that took 5.5 months. And one of them we've been working, and it still hasn't closed yet. It's supposed to close this month, but they've been working on it. And it's been pending, because it's in my overdue pending reports for the Northwest MLS. If something's pending for a super long time, it comes up and it's an alert, and then I have to fill out this report, like what's going on with the property. Because it's like, doesn't look right. You know, I was like, why is this property pending for 6 months and it's a resale home? Yeah, and then this thing's been going since, I want to say since it was June or July. They've been pending and it's still not closed. One of the situations, our buyer ended up renting from the seller
yeah.
and just moved in because he was like, well, it's no big deal. Let's go ahead and rent. And then when we finalize all this, then I've just paid it down a little bit more. And then when I assume that my same, I'm paying the same difference down or whatever, so he didn't care. And he got a freaking like 2.8 something rate. So he's like, there's no way you can get that in this market. So to the buyer, he was like, yeah, I'll do it. And the seller was having a hard time selling at the time. So they said, yeah, we'll do it.
Yeah, well, if you put enough money down,
Mhm.
that's, somebody walks down with a good down.
Yeah, we'll hold on to that because we'll get into that in a little bit. So picking the interest rate is gonna be, a lot of things are gonna have to, you're gonna have to look at. What are current rates? It's if the rate is 7.2% like it was like Monday, maybe 6 or 6.5. I don't know. I mean, whatever you guys, decide to do. But it definitely shouldn't be something like hardly anything. There was someone that came to us that they did this for a seller wanted to sell to a family member. And they were trying to put all this together, and I didn't get involved in the transaction until they were already like in mutual, and they agreed on all this crazy stuff. And the interest rate they gave was actually lower than the interest rate what the seller even had. So it's like you can't just.
Well, and there are usury rules too, where you can't
Yeah.
go above what the current rate is too much. I can't remember what it is, but you can't. Go
Yeah.
like X amount
Oh, yeah.
over. It's usury.
You're right.
Right,
You're
yeah,
right.
that's what's always been there,
Mhm.
even though.
Yeah, you can't charge someone like 20%.
I think it's a set amount over what the current rate is. So like if the current rate is like 7%, you can't charge any more than like 14 or something like that.
But some
Yeah.
people charge less, I mean,
Yeah, oh, yeah, yep.
I mean, some
And
people.
that's fine. That's.
Yeah, and if the seller, they own the property outright and they have got no mortgages or liens on it at all, they could do that, if they wanted to. But realistically, like we told the seller, we said, it doesn't really, I mean, you're not really gaining any, I mean, I know you're not trying to gain anything from the family member, but realistically, like selling it immediately is gonna help you more in their situation because they needed to buy something else. And when they kind of like looked at the whole picture, then they realized, okay, this doesn't quite make sense because now we can't really do what we want to do.
Well, you could also look at some of those secondary companies that buy notes, and you can reverse engineer it. So say.
Yeah, that's a good idea,
It's
Jason.
like an 8% rate and that secondary
Yeah.
company will buy it for 6%.
Yeah.
Make sure that you have your numbers penciled out right. So if you do sell that note, you're netting what you want to net.
That's a good idea. Yeah. All right, so payments to the seller, buyer shall check. So no installment payments are required. Principal and interest installments of. So here's where you're deciding the actual payment. So back. Yeah. Okay. Select the type of payment, insert the amount of monthly installments if applicable. So deciding on what the payment's going to be. Most of the time when you're doing these anyway, you're keeping this a very short-term thing. If it's an owner contract. I personally don't like to see anything over 5 years. 5 years should be plenty. Um, it's usually, I don't know, I haven't really seen. I know one person wanted to do one for 30 years and we were like, why? Is the buyer's credit never ever gonna be good? I mean, really? Why? It just didn't, it was just, I just couldn't really figure out the situation.
Well, if you can assume, an old rate or FHA rate when it was at 3%, then yeah, because you're not.
Well, assumables is different because that will completely end, the seller's involvement. They're not tied to that property any longer once the assumed loan is completed, because then the buyers,
Imagine you can do this in all kinds of different ways. You could do like a 30 due in 3, a 30 due in 5, so it's ammed out over 30 years.
correct.
Or you could do like an interest only for the first 5
That's,
years.
that's mostly what people will
Yeah.
do is they'll do the amortization for the 30 years.
Yeah.
To figure out what is, reasonable
Your
payments,
hand rate.
right? The hand rate, yeah, they'll figure that out and say, yep, this is what the payment will be. But then the balloon is due in 5 years, so they will actually you'll have to pay it off or you'll have to go refinance at that time.
Right.
And that's usually what happens.
So are all VA and FHA loans now? If you're gonna sue them, are they, because it says there, if the lender requires it. So are all lenders requiring FHA and VA loans? If you assume it because with VA, it never used to be that way. I mean, that's people.
Those are the terms stay the exact same for the rest of them.
Yeah, they're exactly
They
the
don't
same.
Yeah.
Yeah, it'll make more sense when we dive into that assumable
The
section.
other mortgages, they have, they're called the due on sale clauses.
Yes.
So they don't allow
They don't allow-
anything. They
yeah.
have to be paid off.
Mhm. Okay, installment payments, it's sort of the timing for any installment payments if applicable. So number 8. All right. Installment payments, if any, shall begin on the first day of January and shall continue on the, let's see, day of each succeeding. So first day of each succeeding, check applicable either calendar month, 3rd calendar month, 6th calendar month, 12th calendar month, or other. Go calendar month first. I mean, typically, they're monthly payments. So you can do anything in there, but that is definitely, usually I don't know. I've just never seen anybody agree to doing that. A seller, why would you want that as a seller? Because it's hard to remember. Oh, when is it? It's 6 months ago. Rather than, oh, it's the first of the month every month. You're gonna have somebody like, oh, did I get the payment? No, I didn't.
There's also service companies that do.
Oh, yeah.
So like they can do like all your impounds for like taxes and hazard insurance. So
Yep.
they pay direct to the servicer. Then the servicer would pay all this other little fee, and then the remainder would go to the separate, whoever the seller is.
Mm-hmm.
I had time,
Instead of managing yourself.
Yeah.
I had a hard time finding someone who used to come, they did that a lot. They were out of business.
Yeah, Note World, they were big back in.
Oh, yeah.
Remember Note World?
Yes. They're gone?
Yeah, they went out of business like maybe 10 years ago.
Okay.
But there are other companies that do this.
There definitely are. All right, number 9 here, we're doing the promissory note and deed of trust. If buyers paying a portion of the purchase price through a promissory note secured by a deed of trust, check promissory note and deed of trust. That's typically the common one we see done. It's either that or it's just a straight up seller contract, which usually you're gonna have to involve an attorney to handle the payment schedule, amortization, and all the other documents that are gonna be designed for the deal and recorded. The important part is getting it recorded. When you talk to people, some of these good old boys used to, oh, hey, we'll shake on it and it'll be all good. Don't worry. You just make your monthly payments. You put this down, you're fine. All of a sudden the person, years and years go by. This happened to my uncle and aunt, like literally their first home. that's what they did. You know, they just did this owner contract. It was never recorded. It was never recorded. So then when they sold it, and this is the funny part, they sold it, paid off the loan. And how the title and escrow company didn't catch it, they recorded it, went to the next person. And then it just fell through the cracks through history. All of a sudden they got, all these years later, they got contacted by someone, would you be willing to sign these documents? We need to go back to because the original owner never had it recorded. It was a broken chain of title. So it's like these things happen and people, they have no clue.
But for me, it always seemed like the biggest difference between a real estate contract and a no deed of trust was the foreclosure period.
Exactly.
And that is where you definitely want an attorney.
Yep.
Because that is, the recourse and real estate contract is totally different than.
Oh, yeah.
Recourse and no contract.
Take it back if it's not me.
What's the difference?
When you're,
Foreclose on it.
Huh?
Do you evict them or do you foreclose? You gotta have that language in your contract.
but you also have it, it's also that you have a 1 year right on a real estate contract to come back and take it back.
Yeah.
So
And that's why you got some of these older sellers who are like, I kind of like the real estate contract myself, because then I just get the property back and you've been paying me, huh?
Slow closure is awful now.
Oh, yeah.
Trying to-
It's way faster in the real estate contract. Right? Or the note and deed of trust is faster.
No deed of trust, the statutory period usually can run about 8 months or 6 months. I mean, time you go the notice, 30 days.
Oh, yeah.
You know, so it takes,
I
usually
can see
takes
that.
about, unless somebody, like when we went through COVID,
Mhm.
then they had a ways to kind of keep.
Now that
Moratoriums.
you gotta cure, you got these many days to cure it, and it can take you 6 months to take the property back.
Well, that was normally about the whole thing, is because by the time you went 30 days no default, no to judgment, and you had 120 days after that, you're in basically 10 days before the foreclosure date. If they walked in with the money and say, then it's all, they can take the property back. But in the real estate contract, unless they've changed the law, which I don't think they have, you technically could think you have the property, but the person was foreclosed on, could a year later walk back, well, I just inherited this money, I want my property back.
Yep.
I think it's called forbearance.
Forbearance. Security. All right, number 10, check the priority for seller's deed of trust. Caution. A second or third position deeds of trust are frequently considered inferior forms of security for a promissory note or other debt. Why is that? Zoom people, you guys been quiet. Why is that?
We're looking at.
Why a second, third? One
Yeah.
is, inferior to number one.
Correct.
Come on, Zoom people. Very quiet, don't move. Call on somebody.
I have no idea.
All right, I like that answer. You don't know.
You just heard it.
Yeah, I'm not sure.
He just told the answer.
Kind of, I agree.
All right, go for it, Jason.
Lien number one is always, first in line, and it takes precedence over anything after the fact. Unless it's a government lien or.
Yeah.
Or a tax.
Tax, IRS,
But
we'll go
anything other
first.
than that, so a second lien position, if they were in default, they could foreclose on the property, but they'd have to take out number one.
Correct. So, yeah, so it comes.
Yeah, if the first lien holder owes, there's 500,000 owed to them. And the property's selling for 600, let's say. And then the second is 150. The third is another 100. Yeah, they're upside down, and if the first one forecloses, they get all the money, and whoever's in line, like, they'll get what they get. And then they'll probably have to, depending on, the situation, if they had personal guarantees and all that kind of stuff signed in there, and then maybe they go after them personally, but.
Yeah, but if number two is used to purchase the property, they can sue them, but if it was refinanced, they can't.
Oh, yeah.
That works.
Yeah. All right. Let's see. Deed of trust, check the appropriate box to indicate which form of deed of trust will be used. LPB Form 22, deed of trust does not contain a due on sale clause. LPB Form 22A, deed of trust, does contain a due on sale clause, which must be separately initialed by the parties. So if we go back to number 11. Too fast. Here's the section right here. Buyer agrees to sign at closing, the following selected. So you would have to check which version that they're going to use. Deed of trust with the due on sale and due date. Due date. So the balance and principal and accrued interest shall be due and payable in full on. So this is typically your 5-year. Default and default interest section. Go back to 13. Mia, you want to read 13 when I get there?
Sure.
Go.
Default and default interest rate, insert the default interest rate, the amount of late charges, the grace period for each monthly payment, and the time period that buyer has to cure any default before seller can declare the entire amount due.
All right, so you guys can decide how much is the penalty? When's it due by, and how much is it, or the total amount, when would it be due by in the event they just default? So these are things like, oh, and this is 18% would be filled in automatically. That's the maximum, or the maximum allowed by law, whichever is less, a late charge of dollar amount or a percent of any installment payments, 5% of the payment if neither is filled in. Shall be added to any payment more than 15 days by default if not filled in. If buyer has not cured any default within 30 days after written notice, seller may declare all outstanding sums immediately due and payable. Sticking to the default's probably a good idea. 18%'s pretty high, but nothing wrong with that if they're not making the payment. Prepayment, buyer may prepay all or part of the balance owed under this agreement at any time without penalty. I know it's kind of funny to have that in there, but if you think about it, sometimes sellers, the reason they do these, they want to like have their money come out and, and maybe they're got an income limit and they're like, I can't receive all this money at once. So there's a lot of things behind these reasons on why is this in the contract.
Well, I was laughing at it. There was an agent whose name shall not be mentioned, who was selling land, who would put this in his contract. There was a prepayment penalty and the rate was really high. And I thought, no, I'm not putting my buyers. So
That's terrible. Yeah, that's
He
bad.
quit doing it because I think the state went after him. But I will not say.
And what you just said there with people with like income, maybe that could be a reason why somebody wants to do owner contract is instead of having all the capital gains.
Yes.
They could have that spread out over a couple of years instead of having to pay that whole. So yeah, I just thought of that when you said that.
Yeah.
So it's another reason why would a seller want to do this rather than just being done and selling it and being completely finished. But yeah, they absolutely might want to do it just because of that one reason. All right, no further encumbrances. Buyer shall not further encumber the property until seller has released seller's security interest in the property. If selected, the deed of trust shall include the following provision as an express condition of beneficiary making the loan secured by this deed of trust. Grantor shall not further encumber, pledge, mortgage, hypothecate, place any lien, charge or claim upon, or otherwise give as security the property or any interest therein, nor cause or allow by operation of law the encumbrance of the trust, estate, or any interest therein without the written consent of beneficiary, even though such encumbrance may be junior to the encumbrance created by this deed of trust. Encumbrance of the property contrary to the provisions of this provision shall constitute a default, and beneficiary may, at beneficiary's option, declare the entire balance of principal and interest immediately due and payable, whether the same be created by grantor or an unaffiliated third party asserting a judgment lien, mechanics or materialman's lien, or any other type of encumbrance or title defect. You probably would mark that every time you're using it, because you do not want this buyer who's agreeing to, do a seller's contract to allow them to also, now I'm gonna do a contract to someone else. Like, you're not gonna want that.
Or they get like a second mortgage or something. And now
Yeah, and then they bounce.
they have no equity at all, and then they're like, I'm out of here.
Exactly. So
Oh, yeah, so I guess my question is I pontificate. So this here, right here is like the whole reason you see an attorney, this
Yeah.
paragraph, because there's so much in here that.
Yeah.
That can really catch.
Well, the thing is with the judgment or mechanics lien, that's like something that the
Right.
borrower more than likely doesn't want to have happen.
Yeah.
But if it does happen, it does eat up all the equity, and so that is a way to protect the seller to still get that property back or be made whole.
Yep. All right, next section is real estate contract. So if you're choosing this option, it's different from the first note in deed of trust option. Note, if the property is primarily for agricultural purposes, then a non-judicial foreclosure or forfeiture remedy is available only by using a real estate contract. So if the property is used for agricultural purposes, you're not gonna wanna do a note in deed and trust. You're probably only gonna wanna do the real estate contract. Very rare. I doubt, you're gonna probably have something like that, but whenever it seems like when there's like land involved, it's a little more common to see these types of deals that, that want to come up.
And
So
that's what we were.
just
talking
be,
about, non-judicial.
yeah, you want non-judicial foreclosure because it's immediate. You don't have to go through the whole judicial process in order to even do the foreclosure. It's already set in place what will happen in the event they do not make payments. So real estate contract, the parties agreed to sign the LPB Form 44 real estate contract. The parties agree to initial and make applicable the following optional provisions in the LPB Form 44. And I don't think LPB 44, I don't think MLS gives it, didn't it? No, that's bunk. Yeah, so that is only the LPO forms. So that's back to these. And it's the 44. Yeah. Right here. But again, these are things you're not going to be filling out unless you pass the bar exam, and you never told me. Even then, I don't want you filling it out. It's got to be recorded. It's got to be notarized. It's got to be done probably, at an attorney's office with a escrow person too, to be able to make sure that it gets recorded. Yeah, stay in your lane, please. Substitution and security on personal property, alterations due on sale, prepayment penalties on prior encumbrances, periodic payments on taxes and insurance. The payments during the current year shall be $1 per month. Last part is cash out. The entire balance of principal and interest shall be due and payable in full no later than date. So you're putting a full date. Again, real estate contracts, those ones you can see a little bit. You probably will see stuff that's higher than the average of the 5-year. Sometimes they're,
This land
15.
might be 7 years.
Yeah, land.
You go to timber, that's what you're gonna get a land loan for, usually about 7
Yeah.
years.
Yeah, so land ones, other ones could be a little bit different. Here we go. Next section. This is the assumed underlying obligations and method of payment. These are the assumable loans. And again, only government-backed loans can be done. That's the only ones. If someone's got a conventional loan, you can't do it.
Oh, you can. It was Jeremiah Long was the person
Jeremiah
who was
Long.
doing this.
The attorney?
Yeah, he was basically in the other court. I think they had one of his associates live in Bellevue back in the 80s. When the Fannie Mae said, no, we're not gonna allow you. Then he basically came back and said, well, here's how we can do it. And he was an attorney, and so you'd send your clients to him. I never did it.
Jeez.
But basically it was like, we're gonna do a real estate contract. So, it says the seller still.
Sells that the seller's released from the liability? No, just kept them on it?
Kept them, well, they kept them on the note.
Oh, geez,
And
but you
so,
can't do that though with,
Well, I mean, that probably can't do it anymore. but
No,
At that time, this, they had some, let's say, ways to get around things.
yeah,
Do on sale clause.
yeah, do on sale clause. All right, so you would check the box, assumed obligations, buyer shall assume the following obligations. So what are the obligations? What are they actually going to assume? Back up to 18. All right. Insert the amount of financing obligations that buyer will assume, if any. Well, of course, it's going to be something. So what are they assuming? What are they assuming, you guys? You don't say, because I already know you know. What would the buyer be assuming from the seller? It's going to be two things, really. It's the remaining balance and the interest rate. They're assuming exactly what the seller has. So if that seller owes, their payoff is only $100,000. We're going to think about these situations. Payoff's only 100 grand. It's a FHA loan and the interest rate is a 4.5, right?
So why is it taking so long from the lender to approve this? And because it seems like to me they're setting themselves up for a class action lawsuit. Because suddenly you're starting to, push something to somebody else. I mean.
Yeah,
One thing. Another thing is.
that's it. Because think about most mortgage companies, they're the servicers. Usually,
Right.
they're the ones who are buying the loans, servicing the loans, receiving the payments, managing the escrow accounts, making sure the taxes and the insurance is covered, blah, blah, blah. They don't have all the mortgage officers typically. They don't have the other people who has to process applications, right? So it takes them forever. I know, should it, I mean.
Well, no, it's because it's really not that
And then,
much.
and then also they don't want to.
Well, that's the whole
No,
thing.
they don't want to. It slows down their work.
Well, no, but actually they want to keep, those are bad loans to them. They want to kick them aside. I mean, if the rates were 7 or 8%, you could assume a 3%, they're going to want to.
They'd much rather retire that loan.
Right, exactly.
Avoid different. Absolutely.
And that's like some attorney's gonna have a heyday with those guys.
But before I confuse you guys, let's read this example so that it makes a little bit of sense, okay? So check this box. If the balance owed to seller includes an underlying loan, that seller will pay from buyer's payments. The following is an example of a wrap. Oh, wait a minute. Did we skip? Oh,
No.
sorry. I skipped ahead.
Yeah.
We're still in 18. My bad.
Yeah,
We're not doing wrap. Hold on.
Don't assume.
Yep. Let me get back to that section. So sorry. Okay. There we go. So here is exactly, I thought the example they were giving was for the one for an assume, but it's not, it's into the next section about a wrap. So assumable loans, what you guys want to look at and what will be a good scenario and what will be a bad scenario. Let's start with the bad first. And just like I was starting to say, seller's home is selling for $700,000. Okay, that's the list price. They only owe $100,000. And their interest rate was 4.5%. Good rate today, right? You would want that.
Yeah.
FHA loan, so the buyer's like, yeah, I want to buy this. In order for the buyer to buy that assumable loan, because how much are they paying the seller? How much is it? 700,000. And they owe 100. So how much can they really assume in this? Their payments, or excuse me, the actual.
Well, they're assuming.
It's 100,000,
Right.
right? So how much money do they need to bring to close this deal?
Well, they would.
600 in closing costs.
600,000 in
But-
closing
But
costs.
this is where it gets interesting, because Usually
See?
like this,
Yeah.
they say they're coming in with, we'll say another 100,000 or 200,000, and they're writing a contract for the balance. And that's what happens in these kind of loans. Because they're not gonna, you're not gonna find somebody who's gonna have $600,000
Ah,
to assume, but if this is closer to 400,000 and the price still sales price, then they might be it. But most often, the loan like property like this,
mhm.
you're gonna say, okay, we'll give you $300,000 a hundred, so bring it in, and you can carry the note for another 300,000.
Yeah, well, in that scenario, instead of the down payment going towards the down payment would retire the $100,000. The seller would seller finance you back the rest of it, and then, so then if it wasn't an assumable loan, it doesn't matter because the assumable loan is gone.
Right. So there's a lot of different scenarios you might see on these types of properties, but how you identify a good assumable loan is probably early, or excuse me, a very low number of years of ownership.
Well, and also
Right.
interest rate.
An interest rate, yeah, interest rate, and less of, like, oh, we owe, okay, 700,000 is the list price. We owe 625,
Well, there was
That's.
right?
Yeah.
Think about it.
Yep.
Then the buyer's like, shoot, to assume this, I only need to come up with the $75,000 difference for the down payment. And I get to get this 3.5% interest rate? Okay, that's a good deal.
But I don't know how far, because I was gonna, Jason might know this answer. There was a time with FHA where it used to be the prime mortgage insurance always stayed with the loan. Then it had a period of time where you could refinance it, or after you had enough equity, now it's back, it always stays with the loan. So if you resume,
You can still,
After X amount of years, you can have it reappraised,
yep,
and if you have 80% equity in there,
they'll remove it.
yeah.
Yeah.
Mortgage insurance, yeah, can be dropped.
That was there was a time
either
after
one.
the short sale market that they went back to the full
Yeah.
time where it was always there, so. Okay,
Yeah. So right away, you guys now know that, if you're in the situation where, because we had one, I'm not kidding, the listing broker is like, yep, assumable loan, interest rate at 2.5%. Or something like that. It was like ridiculous. And so our broker was like, oh my gosh, that would be so amazing for our client. I'll have the lender run the numbers. At this rate, his payment would be this. And the buyer's like, yeah, let's go for it. And then come to find out, like, this house was like 900 something thousand too.
Right.
And the mortgage on it with that, because they put so much down when they bought it, I think they only owed like 300 grand. So it's like, oh, does your buyer have almost 600 grand to put down? If you want to assume that, and they're like, oh, and here they just like wasted days, like doing all this other stuff. So really, even the listing broker didn't quite understand, like, is that really a good property to do that? Unless they wanted to go the route like you guys talked about, like go ahead and drop, like get the payoff or the payoff's going to cover that mortgage anyway for the down, and then the seller can do owner financing. Like if they wanted to do some type of a scenario like that, then maybe.
So what I'm hearing you say, if like with FHA and VA loans, then
Mhm.
if there is that scenario, let's say it's a low debt amount owed on it, and you're coming with more cash, but basically you have to pay off that loan before you can go to a seller. You can't do it easily.
Well,
how you.
It depends how you structure it, totally.
Well, yeah,
In every scenario is different.
but it used to be common with FHA and VA, they wouldn't have all the cash, but they would basically, you'd put down at least 20%,
Mhm.
and then you'd have a second, which would be probably a higher amount, so that they could, you could get in there.
Yeah.
So, okay.
Yeah, there's different, there's definitely different things you can do, but
In a cat.
Yeah. Yeah.
Well, I know that, but I just, I'm gonna probably talk to a lender, because.
All right, so we got to read B. Let's see, Samantha, you want to read B? I'll get more water while you do that. Oh, you don't have your glasses? Oh, sorry. Let's see. Jason, I haven't picked on you yet. You got me, Jason.
Yeah, Peter. Consent of holder of underlying obligation. There is an existing deed of trust, real estate contract, or other encumbrance which is to remain unpaid after closing, and its terms require the holder's consent to this sale. Buyer agrees to promptly apply for such consent upon mutual acceptance of this agreement. This agreement is subject to the written consent of the holder of the underlying obligation within X amount of days, 15 if not filled in, of mutual acceptance. If the holder's written consent to this agreement is not obtained by such date, the agreement shall terminate and earnest money shall be refunded to buyer.
So what do you guys think after hearing the stories? Is 15 days a good number to put in here?
No. That's like. One-
Yeah. Yeah, unfortunately, like two of the people who did them last year, they're out of three of them that I remember, only one person actually had a long timeline in here. And I'm like, oh, now you got to extend that. You're not gonna get that in 15 days for the consent. Cause what's the buyer gotta do?
Basically, make an application for a loan.
Bunch of stuff.
They gotta apply for a loan. They gotta get approved for the loan or they're not gonna consent. All right, section C is the seller wrap of existing loan. Payments from buyer to seller. Seller will pay the monthly payments of dollar amount due on an existing loan by who's the lender, have an approximate present principal balance of dollar amount with interest at what percent per annum computed on the unpaid principal and secured by the property. Such balance remains the obligation of the seller, and seller agrees to pay such obligation in accordance with its terms and conditions. Buyer shall have the right to remedy any default on the underlying obligation, provided buyer is not in default to seller, and all sums so paid shall be credited to buyer's payments to seller. So, seller's wrap of the existing loan. Back to the 19.
But there seems to be. Well, it's like, if you assume a loan, you have to have basically the underlying lien holder's approval. If you wrap a loan, it's saying, I've not seen that. So basically, it sounds like you wrap the FHA or VA loan, you basically could avoid having to do that. So you can still give them a higher interest rate. So I'm just kind of wondering.
Who's paying in a wrap? Who's paying the payments to the mortgage company?
In a wrap, who's paying? Well, theoretically, it's supposed to be the seller.
It's the seller. Is there risk in that to the buyer?
Well, that's where you have an.
Well, they could lose property foreclosure.
Yeah, that's where you have an impound account.
Really, there's other than that.
You'd have an impound account essentially saying, okay, here's where the money, we're gonna send this amount to the lender who's the original lien holder.
Yeah.
And this to you.
Fees and service.
Okay, now you guys you're skipping ahead. Now, there's been people who have done this, literally, they'll do this paperwork, right? They fill it in and they say, oh, it's a wrap. We're done. You just pay your payments to the seller every month, okay, buyer? Yeah, like rent. You're the owner. Uh-oh, wait. I can't get a hold of the seller. Someone said he's on a flight to Mexico and he's taken all of his money and he's gone. He hasn't been making payments this whole time because we just got a foreclosure notice taped to the front door. What do we do?
So your age.
If there is any situation where a wrap is involved, you really must involve a servicer, somebody who is collecting the payments,
Right.
and they are the ones who are dispersing payments. You have to do it that way. You cannot just make it just seller only. Escrow will be your friend, in that situation where you're getting things set up, and they're going to be the ones that'll give you, here's some servicing or payment companies that you can utilize. And there's a cost for it. It's a small cost, but they'll do all of it. Yep, year ends, you need all of that.
So Eric, what do you feel about a wrap compared to a lease option?
I despise the lease options. Yeah,
But they're basically almost the same.
kinda, yeah. And
Well, no, not at all.
we used to
because-
see a ton of those back in the short sale days because there was, people didn't have the credit. And, after those situations and they're like, oh, here's a good idea. Let me go do this.
But the remedy for them is totally different.
Oh, God.
The lease option, basically, you're
You're
a
a
tenant.
tenant.
And
You are.
And a wrap, you're the owner.
Yeah.
And even though, so it's probably with a wrap, depending on how it's wrapped, more, it used to be real estate contract,
Mhm.
to be non-judicial foreclosure.
Yeah.
With, your tenant rights, even with there's an option, which used to be in the lease option,
Mhm.
because there's a whole thing out of the short sale market came, like that's when you start, oh, yeah.
Well, that's what Home Partners of America does.
Yeah, exactly that.
They give you a lease option, they
Right.
give you 5 years
Yeah.
of what you can pay for the house.
Right.
And then I think there's statistically only like 75% of their people end up buying the houses.
Yeah.
So basically, it's them just, they're basically investing into real estate with tenants automatically put in there.
Yeah.
But it's good for us because we'll get the sale.
Yeah.
We get the-
Those are much better. If you're in the situation where it's that, or, the Home Partners of America, it was a good program.
Yeah.
It did some
That's a
good.
lease option.
That is a lease
Yeah,
option.
no, I remember.
To
that.
the,
Yeah, I
to the
never-
person, to
And
the
they-
buyer.
And they do a lot of transactions in each year.
Oh,
Right.
yeah, they've done a ton. All right, so let's look at the seller wrap financing example, right? Check the box. We talked about that part. The following is an example of a wrap. Seller owes 60,000 on a deed of trust against the property. The sales price is 100,000. We need a bunch of those houses. Buyer makes one monthly payment to seller. From buyer's payment, seller makes the payments on the $60,000 loan. So again, Northwest MLS strongly recommends that on a wrap sale, the payments be made to a collection account. Servicer. There's no way in heck you would do this without that. Otherwise, it is major risk. Just like that situation, like that's a true story. Literally, seller just took off. He did this on multiple homes and
You're saying-
just collected all the money and then gone. And then he left the country.
Like I know a guy, he had like 20 properties and he collected on like 18 of them. Didn't pay on any of the mortgages, only paid on 2 of them, and they all got foreclosed on him, but he ended up with 2 that were almost paid off.
We know someone who came in there who owned like 35 houses.
All right.
All of them had mortgages during the crash of the market, 2008, 9, and 10. He just made no payments, collected all of the money. He paid off like 12 of the houses. And he's like, I'm done now. I'm retired. He owned all the 10 homes. He let all the other ones go.
Because back then it could take like a year or 2.
Yeah.
For the foreclosure.
Years.
So they're just
years.
collecting each month on it. Like clockwork,
Mm-hmm.
never paying the mortgage.
Yep. Terrible.
Was that an agent here? Because there was someone,
Well, yes, I was here.
yeah, because there was.
The
someone-
client told us.
Right.
literally.
There was someone at our
This.
office, they hooked up with, I think, someone in my old office, and they basically were subordinating, old people's home, was pretty clear. And then they take. the
Oh,
money.
that one's different. That wasn't that.
That's full on fraud. This
Yeah,
is
that's
just-
fraud.
This is just, you're not.
I mean, that's fraud too. The story of what the guy did, of
Right.
course, you're not making your payments, you're collecting money. All right, we did this cash down to existing loan. If the buyer's going to assume an existing loan and pay the difference between that and the purchase price in cash, check this box. Type of assumed loan, check the appropriate box to indicate whether the assumed loan is a deed of trust, mortgage, or a real estate contract. 122. Here's the type of loan. All right. So finding out which one it is, the assumed loan is is not an adjustable rate mortgage arm. The monthly payments could increase or decrease if the assumed loan is an arm. Loan amount and payments, the assumed loan has a principal balance of approximately how much? And then dollar amount, including interest at what percent per annum computed on the declining principal balance and including real estate taxes, hazard insurance. Seller shall pay any delinquencies at closing. And then section 3, seller warranty loan is assumable. Seller warrants that the assumed loan is assumable, provided that buyer complies with and agrees to abide by any requirements or conditions imposed by the holder of the assumed loan. Buyer review period. This agreement is conditioned upon buyer's review of the assumed loan unless buyer gives written notice to seller of buyer's disapproval of the assumed loan within 5 days if not filled in of mutual acceptance. This contingency shall be deemed satisfied or waived. And then, of course, the seller review period. Seller understands that when a loan is assumed, seller may remain liable to pay the holder of the assumed loan if the buyer fails to do so. This agreement is conditioned upon seller's review of the terms of the assumed loan, unless seller gives written notice to buyer of seller's disapproval of the terms of the assumed loan within 5 days of mutual acceptance. This contingency shall be deemed satisfied or waived. Here's the other terms. Payments to collection account. Collection account, buyer's payments to or on or before of seller shall be made to contract collection account at. A lot of times you guys are never going to know this, until you talk to the escrow company on who the company is going to be. A lot of times I see people put TBD, to be determined. You really got to know who it is first. So make sure you're communicating with, escrow, finding out who's a good company.
This is a point of practice, because,
Mhm.
so if you have, someone seller says you have a assumable loan, which is a VA FHA loan,
Mhm.
then how would you find out how long this could take? Because that would be a good thing to know beforehand.
Well, an assumable, this section doesn't apply, right? This is
No,
still
I'm
the
not
wrap.
talking this, I'm talking about, it's like, because back in the day,
Mhm.
you didn't have to do that with an FHU VA. You just, you basically, you didn't have to go and get approval. So I'm just wondering, like, and what I'm hearing you say is this.
So back in the day, if I had an FHA loan, Jason's gonna buy my house because my rate was 10% back in the 80s.
Right.
And he didn't have to apply with the same mortgager. He could just say, I'm assuming it.
Yeah,
With what? With a contract?
well, they basically, if you're gonna assume it, usually was like they did a lot of partial money deed of trust, what they called it back in the day.
Qualify somehow.
Well, obviously they must not have worked too well because they didn't continue that type of a system.
Well, but I think basically, I think it ended basically when the foreclosure and short sale market changed. Because basically, that was common in the 80s and 90s to have people assume, because the veteran would lose his
Oh, yeah.
benefits until it got paid off.
Yeah.
And so basically, but no, that's why I'm wondering about, because, now for the longest time, I haven't done real estate contracts, no deed of trust. It was much more common in the late 70s, 80s, and 90s.
Yeah. Obviously on the payment terms, I'm calling it the old form. Jeez. Seller's financing addendum, obviously out of all of these options, the wrap is gonna be probably the least common one you're gonna run into, I believe. I really don't see very many.
But a wrap would be easier to sell a wrap, because if you're in a wrap and a lower rate, then the seller might be more willing to take a wrap than to have somebody assume it.
Maybe.
Because basically it used to be, I could figure out the point of return. If you got a 4% interest rate and the rates, and somebody's gonna put down 30% and wrap that at a 6% loan, then his rate of return he's getting money off of what he's ever wrapping.
But then you gotta find out, can the seller even do a wrap
Yeah.
on
Well,
their mortgage?
Right.
If they've got a remaining mortgage at all.
Is that you're gonna buy it for 500 grand, they owe 400,000 on it with a 2%, 2.5% interest rate. Assumable.
You're saying
this 100 grand.
Yeah,
And
exactly.
that's when it would work.
That's the home run.
That's when it works.
Yeah, in our situation, from last year, the one that closed, I think in like November or October, it's November, because they got to move in finally right before Thanksgiving, that's right. It was like that exact situation. The owner, the seller had only owned the property for 2 years and hadn't paid that much, and when they got in, they only put in, and of course, it's a government loan, they only put the 3.5% down. So it wasn't that much. Yeah, and the appreciation didn't happen so crazy last year, right? Or the past few years, it hasn't gone crazy.
That's what it really was.
Yeah, that's the home, those are the actual ones that are really good for a buyer.
The ones with hair that you're talking about, those are difficult.
Yes,
Who's talking about?
Eric, the hair ones, but
Yeah.
100,000.
100,000 selling for 900.
Right.
You got $800,000 difference. Okay, escrow, the collection account shall also serve as escrow for a request for reconveyance or fulfillment deed as applicable, which shall be fully executed by seller at closing and held by the collection account pending payment of funds as provided for herein, and shall be released to buyer when full payment of funds or funds due and owing have been received by the collection account. You definitely are gonna keep escrow. Taxes, insurance, you want all of those to stay the same, making sure that those are gonna get paid. And again, having the collection account, the servicer handle, that stuff is really gonna be important. Seller's review of buyer's finances contingency. This agreement is conditioned upon seller's review and approval in seller's sole discretion of either one, buyer's credit report and score, buyer's income tax returns for the prior 3 years have not filled in. How many years does a lender need? Depends, but commonly 2. They usually only need, at least 2 years.
I'm saying we can do one now with that, self-employed.
Oh, yeah,
Tax return.
that's right.
What is this?
If you can go off just your tax returns
Mhm.
for last year.
Verification of buyer's employment from buyer's employee and either that or other, whatever else you want to put on there. Buyer will provide seller with all applicable information, including credit report and score if applicable within 5 days of mutual acceptance, unless seller gives written notice to buyer of seller's disapproval of the applicable conditions within 2 days, if not filled in, of the date the information is due. This contingency shall be deemed satisfied or waived. I think the dates and timelines for those is a good amount.
And the seller is the bank. So
Yeah, the seller's doing this, so you really do not want to be extending credit to a individual without at least investigating it. And then, of course, title insurance. Buyer shall pay the cost of lender's standard title insurance policy, ensuring seller's security interest, and shall pay for an extended lender's title insurance policy if the cost of such extended policy does not exceed the cost of a standard policy by more than 10%.
I don't know what they were bargaining.
Yeah, bargain and sale deed.
What do you do?
Oh.
So there's like.
Yeah, there's a bunch of different ones.
Yeah. Which one do you need them then? Talk to title and escrow, talk to your attorney.
Boy, yeah, bargain and sale deed's not gonna protect the buyer much, because there's gonna be nothing, what can they do? Yeah. That's probably, that would be an attorney
Yeah.
would have to answer that for the client.
Well, I mean, basically because of how it becomes so much more complicated with this form, is this all for gonna need the attorney? Cause this is probably the form that has the most.
I know. So that is it today. That is it for today, guys. Yep, thank you for making it.
Even though you're not an attorney, you do represent one well.
Oh, boy. I don't know about that.
Thanks, Eric.
Thanks, guys. All right, we will see you on the next one. Take care.